Good day, everyone. This is Joseph Trevisani from Worldwide Markets. Hello, everybody. Our topic today is gold. I called the webinar "The Psychology of Gold: Technical and Fundamentals," and I will explain in the course of the webinar what I mean and why I phrased it that way. I thank you all for attending. As always, I take it as a great compliment that people take time out of their day to listen to what I have to say. And I hope it's both instructive and entertaining. The entertaining part, I don't guarantee. The instruction, I hope. As always, if anyone has any comments, jokes, criticisms, observations, anything they'd like to bring to the attention of myself or the other people in the audience, please do so, and I will respond to it as best I can. Gold. When they opened the tomb of Philip II in Vergina in Greece, they find a pair, among many other things. Philip II was Alexander the Great's father. They open the tomb about 10 years ago, I think. They find a pair of golden greaves. Greaves were the armor ancient Greeks wore on the lower part of their legs. When they opened the tomb of Tutankhamun, what do they find? A gold embossed sarcophagus. Gold has more metaphoric and real meanings than certainly any other metal in human culture. It is an almost universal metaphor for value, for quality, for wealth in human culture. Almost every culture that has known gold, either through trade or mining or conquest, has valued it. So when you trade gold, which we all do at certain times, you are trading more than a simple commodity. You are trading something which our culture, our human culture, not my American culture or an Indonesian culture or Singapore or Germany, alone values. You know, I've written a number of things on the different types of how people create stores of value. And throughout history, they've been fascinating. Sometimes they seem funny, depending on, if you use a credit card, an electronic banking that seems very efficient, and somehow the large stone wheels that the Yap Islanders used as money did not seem so terribly efficient. From their point of view, they work just fine. Gold transcends all of these items. I'm going to read something. I don't normally do. This is something I wrote in October of 2009. And I said, the spectacular rise in gold, this is with from my market directions column. The spectacular rise in gold, now hovering near record territory, it was in 2009, right around here, if you look on the charts, right around here, has been fostered by three very different conceptions of gold. Gold as a trader's choice, gold as a theoretical proof, and gold as historical metaphor. That is my approach to the gold market. Gold as a trading item is traded for more than one reason and by more than one group. And I categorize these groups. And I'm going to go through this, and we'll talk about how gold got to where it is today and what's likely to happen and some of the influences. Let's do a contrast. When you're trading the Dow, you're trading an ETF on the Dow. Your major concern might be the health of the U.S. economy. And as the U.S. economy grows, the Dow tends to rise. That's the historical strength of equities indices. You might be trading the Dow as a proxy, if you would, for Fed funds rate and what that represents for the cycle of central bank interest rates and its effect on the economy and its prediction for the economy. Or you might be trading the Dow as a technical indicator, if you will, meaning that you will look for the technical points, the strengths, the weaknesses, the trend, and that's what you're trading. You're not particularly interested in the Dow's relation to the U.S. economy, or whether the Fed is going to do this or that, or go to sleep, or not do anything. You're interested in the movement as portrayed each day in the market, or how that's going to likely influence decisions of other traders. That's what a technical trader does. Gold has some of these qualities, but gold also has something which I find very fascinating, in that it reflects, let's put it this way. If we look at the three groups of people who trade gold, this is the way I look at it. I'm sure other people have different ways of conceiving the gold markets. What I said was trader's choice, theoretical proof, and gold as historical metaphor. Let's do those backwards. In another column I wrote on gold a little after this, I refer to them as the Armageddonists. Look at this chart here. This is gold on it's a 40-year gold chart, okay? Right around here, and especially right around here, things get crazy. What is going on? And this has happened before, too, back here. But this was the biggest one. A number of things are happening, of course, but the basic idea for the Armageddonists, gold as historical metaphor, is gold is a hedge against disaster. Now, does this play out in some sort of science fiction metaphor where you have a compound? I mean, I don't know if you've all seen Mad Max, but that idea, that early, I think that was the first major movie by Mel Gibson, where society has collapsed and industrial society is gone, and you're dealing on the remnants. This is the old, not the old, but the very much in the 50s and the 60s and even into the 70s, there are a lot of science fiction novels on post-apocalypse, post-atomic war. And this is the idea, that gold is a hedge against this, that if the world is going to fall apart, then, 10 tons of gold in your basement is going to be really good. As a practical matter, that's probably not true. But as a idea of safety, it certainly is true. And two, it presupposes that the world doesn't actually collapse, that you don't end up with Mad Max with a sawed-off shotgun. That's what you assume. And in that context, financial disarray, perhaps, metaphor would be the Depression, then gold perhaps does serve a purpose. After all, if someone buys a lot of gold, the chance of them storing it in their basement and then minting coins is nil. It's going to be stored in some central deposit facility if they actually buy physical gold. That's where it goes. It is nevertheless it's both being treated as a financial instrument, and because in order to take advantage of it, you need to sell some of it. That presupposes a functioning financial system. So that's gold as a hedge against disaster. And I think that's something we can all kind of understand on a basic cultural level. Gold has never not had value in any culture beyond hunter-gatherers. So the assumption behind that is true and valid, and it is one of the things that has prompted this price. And, this price increase. And another thing that's interesting about this, if you look at this price increase, from 2005, gold goes from around 500 to almost to 1900, and it comes back. But where does it come back to? 1200. This is not a purely speculative run. A lot of people are holding gold, period. Let's deal with the next group. The next group I call the people looking for theoretical proof, or the inflationistas. Let me pull up another chart here. I'm using U.S. information, statistics, as a proxy for the rest of the world because gold's priced in dollars primarily, and U.S. is still the biggest economy. Okay, let's find looking for the Fed funds rate. Yeah, let's do this one. Okay, this is the gold price opposed to the Fed funds target rate, the upper bound of the Fed funds target rate. Okay, we have two indices over here. The first one relates to the gold price. The second one over here relates to the Fed funds rate, which the upper bound is 0.25. And the primary reference for these people, remember, I'm talking about different groups that trade gold, and they respond differently. Their time frames are very different, and they affect the gold price sometimes altogether, but most of the time not. We're going to go back to I'm going to explain some of that here as to how this period through here, all three groups that I'm going to be talking about were going in the same direction, and that's why we had such a powerful move. Okay, so the second group is the inflationistas. That suffix anistas is very useful. You can append it to almost any word. It's sort of like ism, which can be appended to anything also to create some sort of ideology or description of an ideology. These groups takes gold as a hedge, not against disaster, not against Armageddon, not against the collapse of the financial world and the coming of the apocalypse, in non-religious terms, please, but against inflation. As Milton Friedman said, although it has not turned out to be completely true, in normal worlds it more or less is. We are not in a normal world, financially speaking. Otherwise, I can't answer for it. Inflation is everywhere and always a monetary phenomenon. Now, that has not turned out to be true. Past 5 years, the Fed has kept interest rates. Actually, we're running on 6 years now. Has kept interest rates at the zero bound. It has pumped tons of money into the economy in the form of various QE and other devices, other financial devices, and there's Zippo inflation. That's a technical term, Zippo, sorry. I think my kids might use that. There's 6. So there has been no inflation, but the expectation at the beginning of all of these gyrations of quantitative easing, of zero interest rates, of financial disintermediation, of all the things that have been going on since the collapse of 2008. Actually, remember, the Fed started reducing rates here. First big gap was here. This is before the collapse. And actually, if you want to look at it, they've been reducing rates from here back in 2007, the end of 2007. So rates were going to go down for a whole year before the Fed, before the financial collapse in the fall of 2008. So for this entire period, there is no coincidence that these two graphs are inverted. The standard role, or the standard idea behind monetist theory and inflation, is that more money creates inflation. The Fed is lowering rates. Sooner or later, we're going to get higher inflation. And what do? What is a good hedge against inflation? Gold. Because gold is priced in dollars. The price goes up as the dollar goes down, but also as people fear inflation. So now, beginning, shall we say, mid-2008, early 2008, we have two groups of the three that I'm talking about buying gold. The Armageddonists, or the science fiction fans, like I am. Not so much anymore, but I certainly was when I was younger. And people who fear inflation. They're both looking at what's going on in the world, at Fed monetary policy. And this, with their predisposition, is a signal to buy gold as a hedge against disaster and as a hedge against inflation. The last group is the easiest group to handle. They're simply traders. Or as I call them, what do I call them? Trader's choice. And they're people like us, you and me, and everybody else we know involved with this business, who are looking to make money trading. They're looking for the strongest, the most reliable trend. Could there be a more reliable trend? Look at this trend. It goes from late 2008 to 2011. For 3 years, you could not have gone wrong by buying gold. Now, depending, of course, on your ability to withstand profit taking and all the other aspects of trading. But as a trend, for 3 years, you could even say more. You could easily take it back to 2005, but I'm trying to draw a little tighter distinctions here. You could not have gone wrong trading by buying gold. One of the things that happened late in this run, of course, that more and more people were getting involved. The latecomers to the party, look at, wow, we've been going up for 2 years. We may go up for 3 more. Well, not quite. But as a trend, the traders looked at gold and said, this is a train we need to get on. So now you have 3 groups buying gold. Usually, these 3 groups are not aligned. Most of the time, in normal financial worlds, the Armageddonists are a very small number. Most people, most of the time, are not anticipating the collapse of the world as we know it, for lack of a better or a more cliched phrase. So in general, in most eras, in most trading times, people are worried about the end of the world, find other outlets for their emotions. Maybe they build a bunker. Maybe they stockpile a lot of canned food. Maybe they discover religion, any particular religion. I know there's a guy in my neighborhood in Manhattan. I mean, he's been around for 30 years, and he doesn't look any different. And he's, I guess, a little nutty. I don't know the man personally. He's now, looks like he's in his 70s. And he stalks the streets every day, holding some kind of text and talking about the end of the world. He's harmless. The world hasn't ended. So most of the time, Armageddonists are in small numbers. Public, dramatic events bring them out. And we have not had a more dramatic financial and public event than the collapse in the fall of 2008 in anyone's memory. The only comparable collapse is the stock market crash in 1929, leading to the Depression. So that group got all excited and started buying gold. Now, I am not meaning, and please don't, to belittle any of the rationales involved in gold. I am only trying to, one, underscore the heavily psychological, almost emotional connection and meaning that this, I mean, look, you can trade oil. And we could pull out, I don't have it up here today, but you could pull up the oil price in 2008. What a ride. But nobody's particularly emotionally attached to oil. And they're not buying crude oil because they think the world's about to end. But gold is a little different. So in the fall of 2008, you had this group buying gold. You also had the inflationists and the last group, of course. So everybody's aligned throughout this period here. Now, don't forget there's more stuff going on here that I'm going to talk about, which kept this rolling. Because for the first group, although the world didn't end, what did we get? Let's find some, let's see which dates I have up. Okay, let's try this one. This is more for the Armageddonists. This is the 2 financial precipitating events, or they weren't actually precipitating, well, last one was precipitating events in 2008. First one is the Bear Stearns collapse, sale to Morgan, I think at $2 a share, in mid-March 2008, and that was a Lehman collapse. Look at the interesting aspect of this. Gold took off right here when Lehman collapsed. Lehman collapse is right about there. That's not exactly right because It was 15, and this is a weekly chart, so that's a 12. Went right up there, but then it came right back. But then later on, as the stock market crashed, as panic started to set in, it didn't set in immediately. I'm not sure I have a price of gold. Yes, I do. Let's take a look at this. I have a price of gold against the industrial Dow, using a Dow as a proxy for fear. I could have done it against VIX. And here you see a closer correlation. Okay? So this is the Dow, and this is gold. And even as the Dow started to recover, it didn't make any difference. And there's a good reason for that. Let me show you why. Let's do the German 10-year, okay? Now, this is a proxy for European fear, if you will. As the American or the worldwide financial crisis sort of ebbed into 2009 and stocks started to recover, what did we get? At the end of 2009, beware of Greeks bearing gifts, I guess is the old phrase, referring to, of course, the Trojan horse and as recounted in the Iliad. But in the fall of 2008, the Greeks, fall of 2009, started talking after Papadopoulos was elected that maybe things weren't exactly copacetic in Greek finances. And what did we get in the beginning of 2010? Why, we got the Greek and European debt crisis. So even though the crisis of the finances, of the world finances that had blossomed in 2008 and 2009 subsided, 2009 we got another great kick at the end with the European financial crisis. So again, the people concerned on all three types of trading got another jolt to keep them interested in the gold market. So, with these aspects of the gold market and why gold trades the way it does, you have to keep these, in my mind, when you look at gold, you have to keep these three ideas in mind as to what the long-term trends are likely to be. Now, this is a comparison of the German 10-year rates with the gold price. So let's compare these. Let's take the German 10-year rate as a proxy for a fear and economic malaise, not a great word, and the gold price in Europe. As the rates come down through this period here, now remember, let's backtrack a little bit. This rise right here is because people are worried about the end of the world. They are worried about inflation because of all of primarily the Fed, but also, the Bank of Japan is news forever, but primarily the Fed, its zero interest rate policy, and QE at various dates through here. I would have illustrated them, but they're really not the point. I want to keep a general picture. And traders. Everybody's cooking right here. So this is going straight up. This period, you have a fair amount of stasis. You're basically trading from the middle of 2000 to the first quarter of 2013. For 2 years, you're trading basically between 1,600 and 1,800. If you think of the three groups, the people worried about the end of the world, their fear may have disseminated a little bit, not disseminated, been reassured a little bit. Nevertheless, most of them are not selling their holdings. In my mind, people who are worried about the end of the world buy gold and they stick with it. In addition, if they buy it anywhere on this run up here, they're still making plenty of money. So that is not going to stir them to move. Inflation, everyone was, not everyone, but almost everyone was, I can't see anyone. I've been saying for a couple of years that, actually for about 4 years or 5 years, that the Fed will end up being right. The Fed's opinion was that they didn't say it, but they didn't give you the logic really behind it, which I will give you my version of their logic. That they simply observed, they're data-driven, as they keep saying over and over and over again, and concern about inflation simply was misplaced. It did not show up. And the Fed was made this point under Bernanke, and they've made it under Yellen. And they're correct. There is no appreciable effect on the U.S. inflation rate, or frankly, the world inflation rate, from the Fed's monetary policy of the last 5 years. There's simply no other way to deal with this idea of inflation caused by excess money creation than to observe the fact that in this case it hasn't happened. You can go through a lot of the logic, but the basic reason is because there's not sufficient demand for money. Businesses are not making loans. People are not buying as much as they used to. There is no multiplier effect from the Fed's creating new deposits owned by outsiders at the Fed. And that's what the Fed is basically doing. Because if a bank sells its MBS portfolio, mortgage-backed securities, to the Fed gives them $1 billion. Now, what does they do with it? Well, they're excess reserves. So they put it on deposit at the Fed. As demand for loans and other types of monetary creation to the bank rise, the bank draws the funds, takes them out, and then can compound them, because the bank does not have to keep a 1-to-1 ratio, of course, on deposit for its outstanding liabilities. Or is it assets? I never did really well with accounting in grad school. I did pass, though. So if the bank finds demand, then it creates a fivefold or whatever is permitted by capital requirements, and new money flows out to the economy. As that money flows out to the economy, it is used by people in the economy to buy things, and eventually drives up prices. That's how money creation works as far as going through to inflation and the inflation rate. Well, there is not and has not been sufficient demand for loans, for money, despite the extremely low price. Money has a price. What was that famous line from, was it Herbert Hoover? Or was it Warren Harding, an American president, talking about the loans that the U.S. had extended to the Europeans in the First World War before and after we joined. And there were people saying, I think as the Depression moved on, I'm not exactly sure about the timing, where various countries in Europe, Germany primarily, but among others, couldn't pay back all the loans because the economies were all collapsing in the Depression. And the comment of an American president, it might have been Harding, might have been Coolidge, probably not FDR, was that, well, they hired the money, didn't they? And that concept is true. Interest rates are the price of money. Monetarist policy is based on this. Monetary policy is based on this. So even though the interest rates have been phenomenally low, historically low, for a very long time, there has been no demand for money. So the inflation idea, but the idea of inflation being caused by too much money printing, or debasement of money, if you will. I mean, the Romans used to do this. They'd start to run out of money, and the percentage of, especially in the 3rd century and into the 4th century, where the economic basis of the empire, the economy had contracted. I mean, one of the later emperors, I think it was Diocletian, actually legislated that if you were a blacksmith, your son had to be a blacksmith. It was kind of the idea of serfdom getting started early. But at any rate, so debasement of money and inflation is historically there are myriad examples of this. The most famous one, of course, are wheelbarrows of money in Weimar Germany. This idea, now empirical, not theoretical, that this vast creation, trillions of dollars added to the Fed balance sheet will not create inflation took a long time, I think, to be accepted. Hold on a second here. I see. Just chalk. Okay, just checking here. Okay, so this period here. Now remember, through this period here, we have the Armageddonists, the inflationists, and the traders. Everybody's in good shape. Let's buy gold. We can't miss. Okay? Right here, everybody took some profits. Hardly surprising considering where we are. This period here, from mid-2011 until the first quarter of 2013, so that's 1 year and a half, almost 2 years. The Armageddonists were not selling gold, but they weren't really buying gold anymore. Things had calmed down. Even by this time, it became clear that most likely the European Union was probably not going to fall apart. The euro, I think, has been an economic disaster for the Europeans, but that's another topic entirely. One of my favorites, but not here, because it involves cultural values as drivers of economic forces, which I find fascinating. But let us continue. Okay, so this period here, to my mind, is sort of the proving ground for the inflationists. Everyone is still holding on to the idea, because after all, it is historical. I mean, I can't think of another historical period where, or even another historical example, where a central bank has, or a government, the Romans or anybody else who has debased their coinage, which is the same as, which is inflation, has done what's been going on now for the past 5 years, and you have not had inflation. Not true. I just thought of one, of course. Japan. The Japanese have been running deficit budgets forever. I remember, sitting on the Tokyo trading desk in the mid-'90s, the late '90s, and every day the Japanese would come out and announce another supplemental budget. They'd build more, storm drains or whatever they're building, and nothing ever happened. There was no inflation. Japan has had endless deflation on and off for almost a generation now. So there is and was another example, but nobody paid any attention to it. The Fed apparently was paying attention to it, but nobody paid any attention to it. Nobody out in the markets. So this period right here, it seemed to me that you're sort of at the proving ground where the people whose purpose to hold gold and to buy gold. Now you can see that people stopped buying gold. They were now trading gold, but they stopped buying it, one, as a hedge against inflation, and two, or first as a hedge against disaster, and two, as a hedge against inflation. So through this period here, you had the proving ground for the inflationists. They weren't really buying, but they weren't really selling either. Who was selling? Well, obviously the traders were selling, the third group. Because their interest is only, well, I thank you for the compliments. The third group, the traders, are only interested, of course, in trading profits. Now, we're all interested in trading profits, but not really. For trading the euro, absolutely. If you're not in that, if you're buying the euro because you believe in the future of the Federal Union and you want to support it by holding on to your euro, well, bless you. But that is not an approach to a trading market, of course. You leave that to the governments. That's what they'll do. So in this period here, the three groups were pretty much stationary. Things had calmed down. The Armageddonists were no longer buying gold. The inflationists were not sure what was going on, and the traders were probably selling their profits and going up and down here. Back here, over here, my interpretation of this chart and what's happened. Yes, that's true as well. True. Goldman did have an effect. Goldman always does. that the two things happened here, and you can see them displayed very well in this chart. The background to me is that the idea that inflation was going to be boosted by Fed's machinations. Maybe machinations was the wrong word. By the Fed's activity, started to wear thin. Sooner or later, or what did Maynard Keynes say? It's about somebody changing his mind. He said, "Of course I changed my mind, sir. When the facts, what do you say? When the facts change, I change my mind. What do you do?" He was addressing someone who said he'd changed his mind on some topic. And well, that's what you have here. The inflation facts have changed. Of course, this stir and this line right here, this weekly line right here, is both the inflationists, the traders, but probably not the Armageddonists, although maybe some of those, selling their positions based just underneath here on the technical point of view of this line right here. Okay? So, the groups that you have to keep in mind for the historical value of gold and what it means to trade are important in this commodity. Now, can I prove that right here, everybody who surrendered or started to surrender, and you got this huge fall of more than $200 per an ounce of gold, was because people who believed in inflation have given up the idea? No, I can't. And as a trader, it's our job to observe what's going on, perhaps refrain from judgment, and to take the lessons from reality. And the reality is, as it started to crack this technical level right here, it was time to get out of gold if you'd bought it at any point up here and you were not holding it for the end of the world. So now, back to where we are now. Again, now we have retreated to a level here. Trading approximately $200 around, up and down between 14 and 1200. So what's going on here as far as the long-term stuff goes? The long-term motivation. The world does not seem about ready to collapse. The financial systems now, I mean, you know, there's a very famous hedge website called Zero Hedge, and it is sort of the pessimistic view of everything. It's very popular here in the States. I recommend it. Don't take all of its pronouncements to heart, because you'll end up being permanently depressed all the time. But as an antidote, as another point of view, its pessimism is very useful. It has lots of it has contributions from various writers. It reposts things. It's also a very entertaining site. I think most of its writers post under the name Tyler Durden. I believe, I've not seen the movie, is a character in the Brad Pitt movie Fight Club, but I'm not sure about that. I think it is. Anyway, so their pessimism is a good antidote, and I do recommend it as far as the happy talk, if you will, that comes out of a lot of other sources. Certainly one source of happy talk has always been the Fed, with their perennially overly optimistic view of the U.S. economy. Okay, well, that's sort of their job. But through this period here, the lack of discernible, if you will, collapse in the world economy is keeping the gold from another shot up. Now, but the inflationists who are either holding it or have gotten out are probably joined the traders. There's no reason through this period right here to assume that inflation is about to start up, despite what everyone has been saying, or many monetarists have been saying for many years. Sooner or later, the only part of that phrase which has been accurate has been later. So there is absolutely no reason to assume. Let's take a look at CPI, and where's my CPI chart? Gold, here it is. Okay. This is a 10-year chart of U.S. CPI and the price of gold. Now, this fall right here is the great fall in prices during the 2008-2009 collapse. It is not an accurate portrayal of any type of long-term inflation. I'll show you a DXY chart in a minute. I have one of those as well. Yes, it is not, but it is the best correlation, and I'll show you that in a second. Let me just finish this right here. But you can see, look at this period through here. Remember, inflation's right here. Inflation goes up to, now remember, the thing about this chart that's tricky is that these are year-on-year inflation prices. So this period here reflects this period here. A truer reflection of real inflation is through here. And you can see that as inflation came off and steadied, the other chart we looked at portrays this also. The inflationists, I think, started to sell out their gold position. It is clear through this period right here that there is not going to be any inflation from the Fed's monetary policies. Maybe yet in the future, but so far, no. I mean, if you're looking at a 4-year or 3-year period on inflation and policy relations, the correlation, and there isn't any inflation, there isn't any correlation. It's not happening right now. You can push it off into the future as far as you want. So when it becomes apparent that this statistical anomaly relating here and here has played out, that through this period, you get a fall in the price of gold. Let's look at DXY. Okay, this is a gold and DXY. Now, another factor, of course, in the price of gold, and here you have, this is a pretty clear correlation. The general downtrend matches the general uptrend. Gold, of course, is priced in dollars. So there's a simple functionality here that as the dollar declines in value, that the gold price must rise. It's a simple it's a simple mathematical relationship. It's not the only thing that is going on with the gold price, but it is also something important to pay attention to. But you can also see that it doesn't always apply. This very large rise in the DXY was not related to the price of gold. It was related to the stock market collapse and flight to safety of all dollar assets. But gold kept going up at the same time, even though the price, the DXY, went up very strongly. So right here, the correlation did not hold. But in general, it is a factor. It's not a largest correlation, and it's easily overwhelmed by other factors. But it is something which you must keep in mind. It is also true of all dollar-priced commodities. Oil isn't falling now only because the IMF reduced its world economic forecasts, or because Germany has had one, I was about to say one semester, it's been a long time since I was in college, 1 quarter of negative growth, and it looks very likely we'll have another, and that the EMU will be in another recession. The third, I think, in the past 5 years. That's not the only reason. Part of the reason, of course, is the dollar has gotten much stronger. Part of the reason the dollar has gotten much stronger, we know. Goes back to the U.S. economy and all that stuff. So it's a factor. It's a factor which you must keep in mind. It's not necessarily a trading factor, but as far as trends go, it is something you want to watch. Okay. So we have dealt with the background on most of on the way I view the gold market and the long-term trend inputs into gold. If another world financial crisis occurs, and there is plenty of reason to think that one could or might. Most of the world, except for the United States, remember in the summer of 2008, I'm sure we all remember there, when ECB did their famous move. I know I've spoken about this a number of times, and they raised rates. Why? Well, because Claude Trichet said there's no problem here from subprime mortgages, and our banking system is isolated from that, then we're not going to have any problems, which, of course, was nonsense and not true. Probably the most ill-advised rate increase that I can ever think of in the history of central bank rate policy. Well, my analogy to that, of course, is the idea that the U.S., even with its very large 11 trillion, I believe, domestic consumer economy, is isolated from the rest of the world. There are two reasons for that. One, it's not. And two, in my mind, the U.S. economy and the U.S. consumer is nowhere near in the sanguine state that until quite recently had been portrayed by the stock market. And the stock market, of course, was actually working mostly on Fed policy more than anything else. However, if wages don't rise, and they are flat in the United States, they are barely outpacing inflation. Inflation is 1.7%, and I use CPI, not the Fed's preferred core rate, because the effect on the economy of wages is affected by the price of energy and food. Last I checked, here in the United States, we all have cars, and we all need to eat. So CPI, as the ECB does, the headline CPI, including those two sectors, is far more important for an effect on the economy. So the U.S. rate, the U.S. consumption, is not, in my mind, as strong as it appears. Therefore, it's to my mind, the U.S. economy is not as strong as it appears. So if, in fact, the U.S. also starts to falter, then you have everywhere. China is a question. Japan is going the wrong way again. Europe is headed to another recession. It is highly doubtful that any policies coming out of the ECB are going to be able to affect this. Germany is quite adamant, but beyond that, it's just that monetary policy cannot have that much effect, especially when it's already at zero bound. The problem, as I said earlier, is not the price of money. The problem is the demand for money. So if we get that type of future, the next 6 months, a year, 2 years, that will give the Armageddonists a reason to buy gold. It will not do much for the inflationists, but any inflationist can always become a trader. It will, in my mind, push the price of gold higher. So I'm looking here that this, I'm going to bring up a gold chart in a second. We're going to take a look at it specifically, so we can take a look at what we're actually dealing with here as far as the market goes. But this period here is analogous to this period here, in that the scenarios have changed. But we don't yet have a replacement. Here, you could say that no one is expecting inflation. As a matter of fact, Europe is headed into deflation. The problem with the European response is the Japanese response. Monetarist policy does not necessarily create inflation. We've seen that. Now, there's a difference, we hope, in that the European economies, some of them anyway, are more robust, and this goes, of course, to one of my other favorite topics, population and population decline and its effect on the economic future. The Europeans are not quite in as dire straits as far as their population goes as Japan is, but they're headed in that direction. Some places in Europe, like Spain, the unemployment rate for young people, 20 to 30 or 20 to 35, is close to 50%. Among many other effects that will have will be a decline in the population rate. Okay, let us move on to the other topic. Let me pull up a chart of gold here. Just move this out of the way, and we will take a look at the actual aspects of gold. Just 1 second here. I just want to pull up a new chart for you. Chart. Gold. Okay, here we go. Let me get rid of this chart. This is gold. This is our trading system in WWM. I am on a Wi-Fi here. This better work. I better not have problems turning this up. So I'll have to use a regular chart if it does. Oh, come on, system. I am not going to be happy if this does not. Uh-oh. Can you all see that? That's not good. Sorry for the delay here, folks. All technology is not perfect. I think I may not be able to use this gold chart. I should have checked this beforehand. My apologies. I checked all the other charts. I did not check this one. Okay, not to keep you waiting, let us go back. I don't think this is going to pull up, so I am going to have to go back to my other chart and talk some more about a little more general. It won't load the chart. My apologies, folks. I don't know what the issue is. It was fine earlier, but it is not now. Okay, so let me go back to the other chart on the 10-year here. This is the U.S. 10-year. So I'm going to talk in general terms about what we're doing rather than the technical terms that I had hoped to speak about. I was actually going to do a technical analysis of gold. What I will do is my next webinar, whatever the topic is, I will tack on a gold analysis. Actually, you know what? I am doing an FX. I forgot about this. I am doing a worldwide markets webinar on the same topic, gold. It'll be slightly different, but the same general topic on Thursday. So if you are interested, and again, I apologize for this. I forgot to check that chart. Go to our website, which is Worldwide Markets, WWM or worldwidemarkets.com, and sign up for the webinar, and I will do the same webinar, slightly different, of course, because I do these a bit freeform, and I will include the technical analysis. I'll make sure the charts work, and I'll do a specific technical analysis of gold price and where I think it's going. It looks to me right now that and I'm afraid I have to put and mention it's one of my least favorite topics, but I will because it actually affects psychology. That is, of course, the potential for some sort of worldwide problem from the Ebola virus. I mean, there can't be anyone who reads that news and is comforted by it in any topic, whether here in the United States or anywhere else. And that enters into the idea of gold and why people buy gold. So it looks to me that right here, where we are, that this 1200 level has proven to be stronger than, has I think been proven. So the bias on gold right now, remember our three groups, the Armageddonists. Well, we've had a very nasty fall in the stock market. I know it's up 100 points today, but there's reason for concern. And if you want to know what the reason for concern is, look at the U.S. 10-year rate. I have a 10-year here. Let's pull up the 10-year rate, and I'll show you what I mean. Where's my 10-year? U.S. 10-year. Okay. This chart was made this morning. This is the 10-year rate. It is at the lowest it has ever been, not ever, but it's the lowest it's been since the middle of 2013. Now, what happened here? Through this period here, QE, the Fed's purchases in the various asset markets drove the rates down. Why? Because the Fed was out buying bonds. Bond prices go up, rates go down. This period right here, from 2011 to 2013, is Fed QE. Plain and simple, driving down rates, empirically driving them down in the markets by buying up and bidding up the price of bonds. That is what's going on here. Okay? So, except for this artificial period here and the collapse in bond rates during the fall of 2008, when everybody was terrified the world was going to end. It was kind of scary, actually. I remember very well. Except for those artificial periods. The Fed 10-year rate is at the lowest it's ever been. Well, what is that telling us? It is not telling us that the U.S. economy is headed for a robust recovery. There are other factors involved here as well. One of them is, of course, flight to safety. It's one of the things. It's not a huge factor, but it is. It's hard to tell how big a factor it is. Another factor is the Chinese are buying U.S. treasuries because they want to keep their currency low. So there are a number of factors here. But one thing that most assuredly it's not telling you is that the U.S. economy is going into a period of strengthening recovery. Well, the U.S. economy right now is the last best hope, it appears, for the world economy. We've been in this role before. If the U.S. economy is not going to improve a lot, then you have increasing concerns for everything and everywhere around the world. Europe's not going anywhere. Russia's got problems, huge problems. China is dubious as far as its actual economic position. All of these, and you have central banks already at the limits of their monetary policy. You do not have a coherent fiscal policy here in the U.S. You have a divided government, and it's likely to be more divided after this next election in 3 weeks. So you're not going to get any coherent industrial or economic policies here in the United States. Europe does not have and cannot have a continent-wide. Europe, the EMU economy, the EU economy, EMU economy, I believe, no, the European economy as a whole is slightly bigger than the United States. But you do not have any coherent or uniform economic development policy there. China is questionable. What else do we have left? So both the price of gold and the U.S. bond market is telling you this. As a catch-up, so is the stock market. So people who are concerned about the future are likely to be buying gold again. People who are concerned about inflation, probably not. But at any rate, they are likely to be neutral on the topic. Because if they're holding gold from back here and gold is going up again, there's absolutely no reason to sell. So their effect on the gold market will probably be negligible. And the last group, of course, are traders. And they, of course, will go with the flow, which is what traders always do. So from here, I think we probably have a potential to the end of the year to rise to 1,300 or a little bit beyond, perhaps even back to 1,400, depending on what the world psychological situation is. And I hate to say it, because the topic probably frightens me as much as it frightens other people, that if you do get a greater amount of Ebola cases in various parts of the developed world, Europe and the United States, you will get a purchase on the gold price. So all of these factors now are changing. It seems to me that that's a scenario for gold potentially is changing again to a pro-gold situation. We shall see. I am not sure if this will play out, of course. But that's my view of gold right now. Again, we have run out of time here. Again, I apologize for not doing the technical aspect of this. I will do it at our webinar on Thursday. I believe it's at 10 o'clock in the morning. I will have to check. It's either 10 or 11. And I will cover that. And in lieu of everyone who was here today and may want to hear the technical aspect of that, I will do the technical analysis of gold, the charting analysis first, and then I will move on to a similar type of presentation today, as I give today. So again, I thank you all very much for coming. I thank you for your comments. I take it as a great compliment that people take time out of their day to listen to me. And I wish you all a very good day. And the Euro failure does sound like a good webinar. I haven't done one of those in a while, so maybe we will do that for the next one. For your information, I do 2 of these webinars a month for FX Street, and I do 2 of them for our own company, Worldwide Markets. Thank you all very much, and everyone have a great day. Take care.